I grew up in a fixer flipper real estate family, and I'd listen to all the real estate, and they say, "Oh, you got to go look at 100 houses in the neighborhood before you buy one." And it's kind of the same as a early stage investor or angel. You have to look at 100 startups before you invest in one.
Yeah.
And that's kind of the ratio. I'd say even now I'm probably 200 to 1 or 300 to 1 for every investment I make. I've looked at 2 or 300.
And that's what I tell new angels. Like, if you go out and you start trying to write direct checks into companies and meeting with founders, like, you're going to see 10 companies and then you're going to want to invest in 7 of them. But fast forward a year, you see 100 companies, you're still probably going to only want to invest in 7 of them because you've seen so much more. You've got so many more reps under your belt. And I tell new angels, like, don't try to start by writing direct checks and meeting with founders. Like, join a syndicate, join a fund as an LP, and just start seeing more and more deal flow. You don't even necessarily have to write checks, but just learning what experienced investors are looking for, why they like deals, what the types of risks that they're highlighting, and just like weeding out a lot of the basic rookie mistakes that you can make in your early days.
Hey, everyone. Welcome back to the Ignite podcast. Today, we're joined by Matt Wilson, a trailblazing entrepreneur and investor. He's the founder, managing director of Allied Venture Partners. His journey spans from building his first business at 11, well, interesting, to a distinguished career in sales and marketing with global brands like Nestle and Coca-Cola. Since launching Allied Venture Partners a few years back, he's grown it into one of Canada's largest angel networks, now with almost 2,000 investors worldwide. He's also a graduate of the Harvard Private Equity VC program. And yeah, just a pivotal figure in Western Canada's tech ecosystem. Canada. Welcome to the show, Matt.
Canada. Thanks for having me on, Brian.
A little known fact is I'm also Canadian. My mom was born in Vancouver, and so I got the dual citizenship before I turned, I think the cutoff was like 26.
That's great.
Yeah.
I don't think do they do that anymore?
Well, tell us about this, starting your first business at 11. That's pretty unique.
Yeah, on the topic of snow, like most Canadian kids, I started my first business shoveling driveways. So waking up before school, 5 a.m., getting out there, clearing driveways. And then depending on how much snow we got, usually because it takes about 20 to 30 minutes to clear a driveway, the other kids on the block would start trickling out. And then before you know it, all the driveways were cleared. So there was no more customers. Fast forward to the following summer, and I'm sitting around and I'm trying to think about how can I expand my business? What can I do? And with the help of my dad, we typed up some exclusivity contracts. So I went door to door in September, signing up the neighbors to exclusivity deals. And it was pretty straightforward. It was $150 up front and then another $100 in February if you were satisfied with my services. So pretty much signed up the entire block. And then fast forward to November, we got our first big snowfall. So I strap on my boots, I get out there bright and early, I start clearing driveways. And then one by one, the other kids on the street, they start coming out and they're knocking on doors and they're getting turned away because everyone has signed up to exclusivity deals with me.
Wow.
And I was in a position to pay the other kids $10 a driveway to help me clear my remaining customers. But that's how it got started. And then the following year, I wanted to expand the business and buy a snowblower, but couldn't afford to buy a snowblower outright. So I asked my dad, I said, what should I do? Like, what are my options? What do you think? I'm hoping that maybe he'd give me some cash. And he took me to the kitchen table, opened up the newspaper, turned to the financial section, and he said, this is called an interest rate. If you were to go to the bank and get a loan, this is what they charge you, and this is the repayment terms, etc. He said, I'll give you the same loan with the same rate and the same payment terms. But he was a smart man. He said, one extra kicker in the contract. He said, but you have to make sure that you clear my driveway before anyone else's. So that was the deal. We signed a small agreement there, and I paid him back with interest. And then the business just grew from that point.
So you went off to college and sold it off or turned it over to somebody or what?
No, I built it basically through high school. And then at the end, I just kind of got tired of it and let it go, let the market come in and fill that void. But so many just timeless business lessons in there, from work ethic, getting up in the morning, to competition, to working with other people, to hiring people to help you with your business, to financing and raising capital from my dad and getting a loan and repayments with interest. So really fortunate to learn a lot of those basic fundamental business lessons at such a young age.
And I kind of missed it. What was the capital infusion for?
For purchasing the snowblower.
Okay, to actually get the actual capital equipment you needed to execute.
Yeah, exactly. Yeah, I could afford about 50% of it. I needed the other half. Just didn't have enough cash to buy it outright.
And then so working with giant corporations, what's the story there? So you went off to college. What did you study, and how did you end up at Nestle and Coca-Cola?
Yeah, I went to undergrad for law, thinking I did pre-law, thinking I'd eventually become a lawyer or a sports agent after seeing Jerry Maguire. That was my goal for a while, but didn't end up going into law. I ended up moving to Toronto, and because I'm originally from Ottawa, I moved to Toronto, actually to pursue a career as a professional ice hockey referee. Started working at Nestle and Coke during the day. My first job at Nestle was actually working in the ice cream division. So basically a giant call center where you're calling major retail clients, gas stations, grocery stores, convenience stores all day long and trying to sell them ice cream. And you figure out pretty quickly how good of a salesman you are when you're trying to sell ice cream in the middle of a Canadian winter. So the biggest takeaway there was just listening to customers and trying to understand what their problems were, right? Like there's no point on trying to sell someone ice cream in January when it's minus 30 outside and they're already still full in their freezer from the summer, right? They have no space to put it. So just listening to them and seeing if there was other cross-sell opportunities, like maybe I can sell you a larger freezer, or maybe I can sell you some more marketing materials. And then I think customers remember that come the summer when ice cream season comes back and they realize like, hey, Matt didn't try and sell me some junk that I didn't need back in January. So yeah, I'm going to place that order. And if Matt suggests maybe buying a little bit more upsell, then I'll go for it because they have that trust. But understanding your customers and listening to them, that was the big takeaway there. And then after Nestle, I moved on and I worked at Coke. And Coke was a bit different because I was now in the actual major retail stores, going to the individual grocery stores, working with the managers, placing their Coke orders, making sure the product arrived on time and was set up properly. And the big takeaway for me was customers, they don't really care how you do it. They have their problem and they want someone to solve it. And if you can solve it faster and better than anyone else, you'll 9 times out of 10 get the job. And one story that really stands out in my mind was it was a Friday before a long weekend and the grocery stores were running loss leader promotions on Coke and Pepsi to get people into the store. And for whatever reason, the delivery in the middle of the week got delayed or it hadn't arrived. So I get to the store Friday morning and the pop shelf is totally bare, both on the Coke side and mostly on the Pepsi side. And thankfully, I was able to finagle and make sure that their drop was one of the first drops on the truck first thing in the morning. So we got our delivery delivered to the store nice and early. And I got everything set up, made sure it was all good to go for the promotion. And then Pepsi had an end cap at the end of the aisle. They had an end cap going, but it was pretty much empty as well. So I told the manager, I said, like, can I fill your end cap for you? Let me put Coke on there. And the manager, he doesn't care. He just needs his shelves filled. He said, yeah, absolutely. Take it. Go for it. Pepsi's not here. You're here first. I have this problem. I have these empty shelves. I need them filled. It's all yours. So that was the big takeaway for me there. Just if you can solve a customer's problem better than anyone else, you'll most likely get the job.
So at some point you're, climbing the corporate ladder, getting all these skills, and you made the shift to entrepreneurship. Tell us about that.
Yeah. So being in Nestle and the ecosystem there, and then Coca-Cola.
Or shift back, I should say, because you had your own business in high school or in the middle school. But yeah.
Yeah, I mean, I was still a minor at that time, so I don't know if I'd really call it an official business, but technically I guess so. And I had always done like side hustles and interesting little businesses here and there. But I'm coming out of the Coke and Nestle worlds, and then my former business partner, he was at Nestle as well. So we saw the inner workings of how the big players and Nestle, as you know, they do Nescafe, they do a lot of coffee. It's one of their biggest selling things. So we saw how the big guys were doing it on the back end. And then we were just coffee aficionados. We would order raw beans from South America and other unique places. We bought a roaster, and on evenings and weekends, we would just sit around and try roasting different blends and coming up with different recipes and whatnot. And we knew our product was 10 times better than anything in the market because at the time, all you had was Tim Hortons, Starbucks, Second Cup, and maybe a small handful of mom and pop shops or small coffee vendors. So there was really no fair trade organic movement. This was all before the fair trade organic thing really took off. And we knew our coffee, because that's the type of stuff that we were ordering. We were ordering the fair trade organic stuff. We knew it was 10 times better than anything else on the market. So we said, hey, maybe there's a business here. And then we ended up spinning up our own coffee company. And then it ended up being a wholesale coffee roasting company that we distributed across the GTA and the Toronto area.
Amazing. And then at some point you decide to get into angel investing. And this was back in 2012. What was that journey transition like?
Yeah, my co-founder and I, we had an opportunity to sell the business in 2012. So I had met my now wife, and she got a job out west, and he had met his now wife, and they were settling down and starting to do the kid thing. So neither one of us really wanted to keep the business going any longer. So I moved out west to Calgary in 2012. And for me, it was just about
I consider like the Midwest of Canada.
Like we're just north of Montana, so I guess that would be considered Midwest. But
it's Rockies, kind of eastern edge of the Rockies.
Yeah, we're right next to the Rockies. I put my skis on the roof of my car and drove out. And I'll tell you, coming across North Dakota, man, that is a boring drive. But I got to Calgary and was just looking to stay connected to the startup ecosystem. And there really wasn't much venture capital here at the time. Like for people who aren't familiar, Calgary is the oil and gas capital of the country. So we're like a miniature Houston. So everything was oil and gas, resources, real estate. There really wasn't much of a tech scene like we have now. So for me, I had to basically look south of the border. So I joined every angel syndicate I could get into, every VC fund as an LP, funds down in the Valley, back in New York, Boston, Toronto, and Vancouver, and just tried to learn from people who'd been in the industry for a long time, write small checks, and it just kind of grew from there. And then I was also doing a little bit of consulting and advising with startup founders, helping with their sales and marketing strategies, because that was my background. And then over time, as my investor network grew and my founder network grew, started to realize that most of the founders I was working with also struggled to raise capital. Just started to be that bridge, make those connections, write up pretty brief 1 to 2 page deal memos, send it off to investors in my network, why I like the company, why I thought maybe they'd want to take a look, or how it aligns with their investment thesis. And some founders got meetings, some founders didn't, but just to try and be that bridge to help local founders get introduced to more sources of venture capital. Because the oil and gas executives that you have here in town, when you go to pitch a SaaS company, they kind of look at you like you've got a third eye. They don't really know. And rightfully so, right? They made their money in oil and gas. They understand that. So that's naturally where they're going to invest.
So it sounded like that was a large hill to climb. And I love that story of just getting started, right? Like you get to Calgary, but what was that? Why startups? You had a coffee roasting company, it sounded like, and you'd worked in big CPG brands. Like what sparked that interest?
I'm a startup entrepreneur through and through, like to the heart. Like I love that, like the 0 to 1, just coming up with something in your own head out of thin air and putting something out there in the world. And I love the early stage startups, like just putting a product in market. And that's what I'm most passionate about. Also too, I was just thinking about other ways. Like I've got some money now from our coffee liquidation. So I'd like to maybe start investing that maybe back into startups too. So discovered angel investing, and it's been 12 years now. So
Allied VC now is a pretty big network. Is it regional? Kind of tell us about what Allied VC does and how you grew that network and who's in it.
Yeah, so the first 100 or so investors when I launched in 2020 were just people from my own network, other angel investors, VCs, and just said that, hey, I'm seeing enough deal flow now where I'm going to start trying to syndicate some of it myself. So we're predominantly North American based investors. We have some people from Canada, more so in recent years. I think a lot of Canadian investors now are starting to come and take notice of venture capital. But in the early days, most of the investors were US based, people that came from the tech world, interested in angel investing in technology companies. And I ran it through the AngelList platform. So as you know, they have the social network on the back end, so LPs can discover your syndicate and vice versa. And then I also co-syndicated my first few deals with some of the larger syndicates on the platform. So that really helped get me exposure to new LPs and snowballed the LP base from there. But it was just basically word of mouth from that point on. Like people told other LPs and continued to share interesting deals that people were excited about. And here we are 4 years later, close to 2,000 members.
Yeah, really interesting story. I'd love to kind of dig into the deal flow aspects. I think an interesting way that you started was with the deal flow. Tell us how you kind of grew that deal flow and how you got involved. And you said you were sending around memos to other investors. And
when I was a private angel investor, like I would put together a 1 to 2 page quick memo and send it off to an investor that tell them why I like the deal, why I think they should take a look at it. And then when the syndicate,
how did you find that deal? Like, it's kind of a 0 to 1 problem, right?
Just networking with founders in my personal network, a lot of Canadian founders as well. Like at the time, because now we've got a pretty robust tech ecosystem, lots of startup events, but there would just be like coffee meetups with 6 or 7 people there and different startup founders and people bringing the same issues to the table, struggling to get funding, et cetera. So it was really small and niche at the time. So I was able to sort of suss out those pockets of people. But yeah, just through my personal network and then trying to connect them with other investors that I knew invested at those stages and those types of industries and those types of verticals.
Yeah. And I'm very familiar with the Grow the Syndicate on AngelList. That's where I got started 5 years ago. I've since divorced myself from AngelList for a variety of reasons, but it's an excellent place to get started. Knowing what you know now, would you go through AngelList again, or would you kind of run off AngelList?
I think so, just because, like, especially at the time, and it's still kind of true now, like, if I was in the Valley and I was surrounded by tons of tech talent and tons of investors and I was in the heart of the action, then it'd be a lot easier to build up an LP base and a deal flow base. But because, I'm based here in little old Calgary, Canada, I need a platform that helps me expand my reach and gives me additional distribution to LPs and founders and other people that I wouldn't get to connect with otherwise. So well, some people like AngelList, there's some people not so much. And I guess it's kind of a love-hate as well. But yeah, they've really, like, without that platform, I would not have been able to do and done what I've done so far.
Yeah.
So
I think
think
it's a
I'd
little
stick
different
with that.
now. And as we enter, 2025, or right as we record right at the end of 2024, I think it was a little different 4 or 5 years ago. It just wasn't as clear where you could run syndicates at scale.
Mhm.
And AngelList really pioneered that, 12 years ago.
Do you guys aren't running on AngelList anymore? Is that correct?
No, we run everything on Sidecar now.
Okay.
They're less expensive. They have lower mins. They're more flexibility in the terms and the structures, and
Mhm.
they don't cross market to your LPs and sell them other competing products and syndicates. And
Right.
I mean, in one case, I had a fund that competed with AngelList, and so they would literally market to my LPs. They're pretty much a similar fund thesis. And so I wrote an article about it. I was kind of pissed off and left and wrote a pretty scathing article about
No
their
kidding.
practices. It's
Yeah,
not
that
fair.
is very true. There's some pretty blurred lines there. You're right with regards to
Yeah.
cross marketing at the LP level, but
Yep.
interesting. Yeah.
Somebody told me this, 4 or 5 years ago. A VC pal of mine. I was an LP in his fund actually, and he's like, I wouldn't run it on AngelList. I would just build it off AngelList and maybe run it on Carta or something else. And I was like, well, it's kind of cool because I get exposure, like all the things that you said, the benefits. I'm building my LP base. I get PCN network access and all these things, but you realize that AngelList views GPs as like kind of a means to an end, not
Yep.
the end itself. Where Sidecar, you are the customer. The GP is the customer. On AngelList, they view the angels and the startups as the customers. And the
Yeah.
GPs are just kind of like this middleman means to an end thing.
Yeah, I guess like if you want to do like a long-term legacy firm building exercise, for sure, you're probably going to have to spin off AngelList or do your own platform eventually.
There's a little bit of a stigma, I think, attached to AngelList too, where it's kind of like it's a step above the crowdfunding sites, probably like Startup Engine and others, or Star Engine, but it's a step down from kind of the tier 1 and 2 kind of VCs, I think.
Hmm. But yeah, I know I've done more deals on Sidecar and stuff recently, and yeah, they're giving them a run for their money. I think
They
it'll be
really
interesting to
are.
see where this goes.
Yeah, and they have this kind of software first kind of mentality, and they're doing a good job. Just shout out to Sidecar. So, how has your thesis changed over time? This is always a question that I get. What's your thesis? And I always have trouble answering it, but I'd love to hear what your thesis was going in to this angel investing thing and how it's morphed over time.
Yeah, so just leading up to before I started Allied, what I noticed in the local market was sort of the emergence of three unique forces, if you will, sort of bubbling up. And if you go under, there's a Venn diagram on our website, if you go on our website, that kind of shows this as well. But at the time, like, we had local investors that were starting to diversify. They wanted to diversify their portfolios a bit into tech and get a little bit away from oil and gas. So we had local investors looking for diversification to technology deals from venture capital markets like the Valley in Boston and New York. Then we had local startup founders who were also looking for experienced venture capital technology investors from some of these markets, because they were banging their head on the wall trying to pitch local investors here who just didn't understand tech. And then more recently, in the last few years, now that we have a pretty robust tech ecosystem, we're starting to see outside investors take notice. We now have one of the fastest growing tech ecosystems in the country. So just 2 weeks ago, actually, I introduced a local Calgary company to a VC firm in Austin, and they signed and wired within 2 weeks. So we're now seeing outside investors looking for a trusted deal flow access point to local market opportunities. So these three forces are kind of coming together, and that's where I'm trying to position Allied at the nexus, so we can help local investors get diversified deal flow access, local startup founders get diversified access to capital from experienced venture capital markets, and then help outside investors improve their deal flow. And with the Canadian dollar right now, you basically get a 30% premium if you invest in Canadian startups, because our dollar is so much weaker than the US dollar. So it's becoming a really attractive place to invest capital. And similar culture, same time zones, really close 2 hour flight to a lot of places in the US. So it's a really attractive place for US investors to look for opportunities. So
Yeah.
yeah,
So it
just
sounds like it's a pretty agnostic thesis. You focus on Canadian startups across all sectors, but mostly early stage, I would assume.
yeah, geographically, we invest across Canada and the US. So we're North American focused. I call it infrastructure layer software. So software that provides the underlying core infrastructure to enable and democratize access among large and rapidly expanding markets. So Think about platforms like a Facebook or a Shopify or marketplaces like an Uber and Airbnb. We also love our fintechs, our APIs. We tend to lean more towards the enterprise software side. We'll do some on the consumer as well. But yeah, we look for companies typically at that seed stage, post product, post revenue. They've got a few $1,000s a month, a handful of customers. And now it's just a matter of, can we pour some fuel on the fire and get them up to that Series A mark?
Very similar thesis to Team Ignite. I love
Mhm.
it. We'll have a lot to talk about. So as you recruit these angels from North America, you kind of run into this Canada domicile, US domicile, legal and tax implications. You probably get this question a lot, both from startups and LPs, with the caveat that, hey, go talk to your accountant and your lawyer. What are some considerations for both Canadian citizens and US citizens who might be listening when they invest in either startups that are domiciled in usually Delaware, or I don't know where it is in Canada, Toronto or whatever?
Yeah, usually depending on the province or like a nationally federated or incorporated company. But, yeah, it used to be more of a consideration. Now it really doesn't matter too much. We have enough tax treaties in place where it doesn't really impact you. Most of the Canadian companies actually that we invest in, because I tell companies we're looking for venture scale, venture backable companies. So if you're based in Canada and you're looking to build a venture scale company where most of your customers are going to inevitably be from the US and most of your funding is going to come from US VCs, just start by incorporating in Delaware right from the start. And we
Yeah.
have several companies that are, even though they're HQ'd in Canada, they're actual Delaware corporations. So it just makes it easier because we know that most of the dollars are going to come from US VCs. But yeah, Canadians don't seem to mind because their gains are going to grow in US dollars. So eventually, when they convert that back to Canadian, they'll capture or recapture that premium. But yeah, no, it hasn't been much of an issue. And I know you had recently on from C100. You guys were talking about
Lars.
how they were able to help improve cross border investing and basically make it into a non-issue now. So
Right.
thankfully, that's really improved over the last few years.
Yeah, yeah, very nice to have. I remember one thing I used to run into on AngelList is I had to put up 2% of the monies raised in the SPV. Is that still a thing?
That is still a thing, and I
Yeah.
put up at least 2% anyways into all of our deals, so that doesn't really matter to me. But yeah, you need to put up at least 2% in order for Canadian investors to participate. But I also noticed too that they recently changed the regulations, or the Canadian regulators, that you can now share carry with Canadian individuals. You could
Hmm.
only previously share carry with US based individuals,
Oh.
but thankfully
Hmm.
now, yeah, which works out well for us because we have a scout program where we share carry with people that refer deals and help us negotiate deals and
Yeah.
secure investments. So it's great now to help expand our Canadian deal flow.
Yeah. I love that. It's something I always considered doing on Team Ignite and never did. I think my reasoning for not doing the scout program, and I've considered it. One is I don't run on AngelList anymore, so it's hard to share deal by deal carry. But two, it was kind of like, deal flow is like a dime a dozen. It's kind of like, if you're not willing to share deal flow with me, why should I share deal flow with you? And so it became this like thing of like, but some people are incentivized by that 5 or 10% or whatever it is for the scout program. Some famous VCs have had scout programs for a long time and share 10 or 15% of the carry. Yeah, maybe you
Yeah,
can walk us through your reasoning for that.
Yeah, for me, it was just about getting access to small networks. Like Waterloo is a great example. We have some people in the Waterloo Toronto corridor that see a lot of really interesting deal flow and stuff before anyone else.
Hmm.
So, and then that way with the shared carry, we can essentially align incentives. And then it also works out well because we can share carry with non-accredited investors. So that actually gives people, helps democratize it a little bit more, where they can now participate in the economic upside if that company does well, and they don't necessarily have to be putting money into the deal as an accredited investor. So opens the door a little bit there as well, just because you see a lot of university programs and students in university who they're not accredited, but they come out of the innovation lab or wherever, and they see some really interesting opportunities. So I want to have some type of mechanism where I can capture that and gain access to
Yeah, that's very nice of you. Thanks for doing that.
it. Okay.
So after you make the investment, let's talk about how you support the founders. You obviously have expertise in GTM, so you're probably helping there. What are you kind of looking for as you kind of those monthly and quarterly updates start rolling in, and how do you get involved?
Yeah, so we don't have like a broad platform team. We're not going to be hiring people for you, running your marketing, etc. But for me, what I tell our founders is we have a very diverse network of investors. We have executives from Apple and Google to people who've started startups. We have startup lawyers, marketers, HR people. So try and leverage that network wherever you can. So our founders will, whenever they send out an email update, they've got their asks in there. We need help with this, this, and this. So I'll always share it with our network. Hey, is there anyone who can make an introduction to this company, or does anyone who's had this issue before can jump on a call with one of our founders and try and hash that out? So I just try and leverage the network where I can because they're so diverse, and that really gives me a unique edge over a VC fund whose LPs, they're institutions, endowments, pension funds who won't step up on an operational level to help out portfolio companies. So that's my big push and edge that I give to founders. And I tell founders too, like, yeah, raise 80% of your round from traditional VC firms. That's great. But I think it's really beneficial to leave room for one or two angel groups or one or two syndicates, because you never know, like, the unique opportunities that might come through that network. We had one deal, we did a pre-seed deal, and one investor put in $2,000, and then the company did well. They went out to raise their Series A, and they were looking for lead Series A investors. And that same LP was able to introduce them to a firm that subsequently put in $500,000. So, like, you never know. Like, don't
Right.
write off the little checks, because you never know. People have such interesting networks, and what is it, like 6 degrees of separation or 2 degrees of separation, especially in this industry. So,
Probability you can get a direct or indirect intro probably goes, it's probably some version of the Metcalfe's law, right? Probably
yeah,
goes to the square of the nodes and of your cap table.
yeah, exactly.
The value of your cap table is square of the entries on your cap table. So yeah, I think that's exactly right. And what I used to tell founders is, yeah, for one entry on the cap table, you get 20 or 30 angels who really care to have their own hard-earned dollars on the line, and will do whatever it takes to not lose that little $2,000 check, because it might mean a lot to that angel.
Oh, for
Might be
sure.
1 or 2% of their, well, if you just take accredited laws, it might be 1% of their income last year.
Yeah.
They
I
put one
remember
100th of their time and energy and income on your startup,
totally. Yeah. And they're going to like and retweet and repost all your stuff. And
all
they're
that
going to
stuff.
tell their friends, they're going to use your product if it's consumer products. So, yeah, those little
They're going
angels,
to
they
repost
tell
your
you.
posts, and it's the
Exactly.
power of the network. Yeah, it's
100,
all those little things.
100%.
Um,
Yeah.
I love that. So you've done some really cool events like the Calgary Beer Week. Tell me about that. I like beer.
Yeah, that was just a passion. It started as a passion project. My buddies and I, we would go for beers after work on a Friday, and we started like standard consumer product playbook. We started on social media, built an audience, sharing some of the local craft beers that we were drinking. And at the time, there was a big explosion in craft breweries in 2015, 2016. Craft beer was taking the market by storm, and then we rolled that into a live events business. So we started Calgary Craft Beer Week, and then we
Oh
did
wow.
that for a number of years, and we had over 30,000 people at various events. And then ultimately, when we got tired of being beholden to advertisers and advertising budgets, we launched a consumer membership subscription platform. So
Oh wow.
people would get their digital membership card on their phone, and then they could go around to all the different breweries and get a special deal or discount or incentive. And that was fantastic. It was a great business until ultimately COVID came along and absolutely crushed the live events business. And then we ended up shutting it down about a year and a half later. But yeah, that was awesome. It was such a fun experience, and we donated a lot of money to charity as well.
That's so cool. So you've spoken a little bit online about metrics versus people and investments. You mentioned metrics are great, but people and culture drive success. How do you assess that as you kind of go into a deal? And what it sounds like people matter more to you than the metrics, but tell us more about that.
Yeah, I made this mistake when I was starting angel investing, and I still see like a lot of new angels make the same mistake, but they mistakenly overemphasize, I think, metrics and product, right? They look at the product. Oh, would I use this? Am I the ideal customer? Do they have traction? Do they have customers? And then they underemphasize the team and the people that are doing it. And I would say in the early days, I was like 80% product and metrics and 20% team. Now it's totally flipped. I'm like
Hmm.
80% team, 20% product and metrics, because I know that the stage at which we're investing, the product is going to change 3, 4, 5, 6 times, right? And it's like that saying goes, you give a mediocre or a great idea to a mediocre team, they'll screw it up, but you give a mediocre idea to a great team and they'll either make it better or come up with something even better. So it really comes down to the team in the early days for the types of stuff that we're investing in. And even if they're not a former founder, they can be a first time founder. It doesn't matter if they've started a company before. But some of the stuff that I look for, it's like, what have they previously accomplished in their life? Whether that's in academics, maybe they were a service member, were they in the military? Did they accomplish something in athletics? Maybe they were a high performance college athlete, or maybe they started a charity or volunteer organization, right? So something that basically shows resilience and accomplishment in a team environment, I think that goes a long way.
I love that. I don't know where I fall on that, and how it kind of changes. When you say it matters a lot early, or in the early days, what do you mean by early days?
Just like pre-seed through Series A because we know the product's going to change so many times, right? Like the initial vision or the initial idea or product is probably not what it's going to be come the Series B. It's going to change and evolve, right? So yeah, just because it's the people ultimately when times get tough and you're going through that J curve, they're the ones who are going to have to be resilient and fight through and stick together and come out the other side. So
Yeah.
if the product seems great today, but it's kind of a momentary fad, like I kind of think back to the NFT craze of 2021, like, yeah, that was super cool and people were dumping in money, but as soon as the market fell out from underneath, a lot of people just left that vertical, right? So
Yeah.
are these people like long-term, passionate, resilient? Are they going to push through walls and break down barriers and make this thing exist regardless of what the market does? So that's pretty much what I'm looking for.
This is hard to suss out, I think, when you're an investor, right? Because, metrics matter to a certain extent. Maybe it's only 20% in your framework, but let me give you a case study. Somebody raises a 500K pre-seed round. They're now 12 to 18 months down the line, and they have, 2 or 3,000 a month of recurring revenue, and they burnt up that 500K. It's an amazing team, right? You invested last round. Do you double down now that they're at their seed round? They only have, 40, 50K of ARR to show for that 500K they burnt through.
Mhm.
But they got a really good plan. Do you it's a case by case, I think, but like, how do you assess that now?
It really is. And I think it comes down to looking at, like, at least since I invested, have they done what they said they were going to do? Have they executed that plan? Obviously, things are going to change once they start executing a plan. Maybe there was market conditions, something changed, but are they at least doing what they said they would do? They're executing towards their goal. If the growth is a little bit slower, then it's like, why is the growth a little bit slower than expected? Well, because of this, and these are the three things that we're doing to fix that. We're talking with customers, we're adjusting the product, and we anticipate things will really start to exponentially grow from here. So, like you said, I think it really comes down to a case by case basis.
Mm.
But if the team was changing ideas every couple of weeks or every second month, they had a different direction, and they were basically just throwing stuff on the wall to see what sticks, then I'd be less inclined to do the deal. But if they have some type of unique insight into the market and they still firmly believe in that, and it's just a matter of time of building up that product and getting to that initial snowball before it really starts building up, then yeah.
So I'll take the inverse of this too. Like,
Okay.
imagine you meet a company, they raised the 500K round, they burnt through that, but they have 2 million of ARR now, or 1.5 million of ARR. But they appear to be like just an okay team. There's typos in their deck. Things look kind of weird, but somehow they got to 150,000 of ARR, and it's growing 50, 60, 70% a month. How are you assessing that company, right? Because now you're kind of looking at the teams like, this team is definitely tier 2, a B player kind of team. What are you looking for there?
Well, they're definitely, I guess their initial insight is definitely correct about where directionally the market was going. But maybe now it's a point of sitting down with the team and saying, hey, listen, where are your weak spots? Maybe we can bring in people to help fill in those weak spots and really round out the team and take you guys to the next level.
Mm.
But obviously they're doing something, right? They've got some type of initial vision or initial assessment on the market that is clearly proving out. It's starting to grow exponentially. But yeah, like now it's just a matter of getting more people at the table that really know what they're doing and bringing in those supplementary team members that can round out the skills of the team.
Yeah. I think somebody said it best, and I forget who I'm quoting here, but it was something like, it's a paraphrase of what you said earlier, which is wrong team, right market, market wins. Right team, wrong market, market wins. And so, like, really kind of as an investor, I think what you are looking for is like this like timing question a little bit, and this market kind of question. Like, what is the problem that you're solving? Is the market ready for this? Is it the right time for this?
Totally.
And then, okay, great. Can you execute to this point where you can find some PMF and we can get the right people on the team, like you're talking about?
Yep.
Or like, hey, you're the right team and this is the right market and the right time, and we're just confident you're going to figure this out.
Yeah, and I think like core to our thesis, and I'm sure this is the same with you, but like we want to see the overall market growing at a very rapid pace, like 20% CAGR, in that range. So
we say CAGR,
CAGR, whatever people. It depends on what side of the border you're on, I guess. But yeah, just like at least the rising tide will help lift all boats, and then in that regard, there's higher likelihood of some type of soft landing if things do go south. But yeah, we want to look for large and rapidly expanding markets regardless, right? So hopefully they can fill out the team and figure it out if they're lacking in certain areas.
Yeah, you just think about like if Facebook came across your desk, right? You're an angel investor. And it's like, yeah, we're growing 100% a week, and we dropped out of Harvard to work on this. It's like, cool. Can you send me the wire info?
Yeah.
Like
Take
basically.
My money.
Yeah, exactly.
Yeah.
Or I think about those, go ahead.
No, when you see those metrics, absolutely, like the metrics don't lie for sure, 100%. And then,
Yeah, it's
yeah,
like obviously you're a smart team. You dropped out of Harvard to work on this, and you're growing, yeah, 100% a week or whatever, and you have 97% day one retention and 90% 1 month retention. So you're looking at the metrics, and the metrics are like off the charts, team off the charts, and then you're kind of thinking about the market and the timing. Yeah, the internet's this thing, and people want to connect. So you kind of look for those. It's hard. This is actually probably one of the easiest jobs in the world, but it's also one of the hardest
well,
because of all these things, right? You're kind of like it's almost like playing poker. The all-in guys are, say, hey, learn poker. It's such a great game. A lot of it is just waiting for your cards. You're kind of waiting for those pocket aces. I got pocket aces here. I got the right team and the right traction, or I got the right team and the right timing,
yeah.
right market.
And I think
And
too, like some investors, depending on how you do it, but like if you have that prepared mind where you've got a specific thesis already laid out, and now you're looking for the company to fill and execute on that,
mm,
versus if you don't have a specific thesis, you're just looking for interesting companies, and then you're delightfully surprised to come across a company in a specific vertical. You start doing more research, you learn about that, and you're like, oh, wait a second, there's actually something really interesting here. I should take a look at this. So like I don't really sit around thinking about where I think long-term markets are going for specific verticals. Like it's just too hard without a crystal ball and without a larger team. Like I'm basically like I'm open to being surprised any day of the week if a founder comes and presents a product that I would never be the ideal customer for, but hey, it's in a really lucrative market that's rapidly growing. It's very, very large. Okay, great. Let's take a look at this. I don't care if I can relate or not. If it's a good business opportunity, I'm going to want to look at that more closely.
so you've done a lot of formal education. You've been through accelerators, Harvard's VC program, got an MBA. What was kind of driving that, all those decisions to do all these things, and what was the most valuable, and what was your experience there?
I'm kind of obsessed with like trying to figure out, I guess I'm healthily paranoid, I call it, like trying to figure out the stuff that I don't know. What are my blind spots? Where can I fill knowledge gaps? So, like for me, as in my 20s, I always thought, what do I need an MBA for? Like, I'll learn way more by starting a company or joining an early stage startup than I will, going to some classroom with some stuffy professor who's been out of the workforce for 20 years or maybe has never been in the workforce. So, that was my mentality for a long time. But in my 30s, I realized, listen, I've got some knowledge gaps here and some blind spots. I should go to business school, really try and round out that knowledge. And that was fantastic. My MBA program was incredible. I wouldn't trade that for the world. And then in my mid 30s, I came across the Harvard Venture Capital and Private Equity course. And that was excellent as well. Definitely a little bit different because, as you know, Harvard, they're famous for their case study method where they break things down to first principles. But the big takeaway there was just the diversity of perspectives from my classmates because you're in a classroom with 20 other people from all over the world. We had people from New Zealand, the Middle East, Asia, Europe, and we'd look at these case studies and yeah, it's the same like metrics and the same business, but everyone's looking at it through a different unique
Mm,
lens. And one interesting story that comes to mind was we were looking at a non-alcoholic beverage brand. And here I'm thinking it's probably not really something I'd invest in, like it's such a small niche market. And then one of my classmates from the Middle East, where they don't consume alcohol, he's like, oh no, like it's the fastest growing beverage category in all of the Middle East. Like it's a multi billion dollar category. And I'm like, oh, wait a second, that's kind of interesting. So,
mm.
and then fast forward now, we're seeing non alcoholic SKUs absolutely taking over in North America. I've got a friend who owns a brewery and the non-alcoholic SKU is now outpacing his alcoholic SKUs.
Yeah.
So just like the diversity of perspectives there. And then, yeah, you mentioned the VC lab program. I went through that in 2023. And the short of it is like my longer term vision for Allied is to build out a fund and a syndicate co-invest model similar to
Yeah.
what you have at Ignite. So that
Right.
was about building out the playbook to launch eventually launch a VC fund. So again, fantastic program as well. I can't speak highly enough about Mike and Adeo and the team and the
Yep.
curriculum they put together there.
Yeah. And I was cohort 7 back in the summer of 22. Yeah, that was a very tough program. Two and
Yeah,
a half years on.
it's not to be taken lightly. What is it? 6 months and 20 hours a week? Like it's legit. And I think
You
something
basically
like
have to go full time. I mean,
it,
more or less. And
it
yeah,
really is.
yeah, I went full time not too long after I exited that program.
Yeah. I was cohort 10, and I think like 1,000 people applied, 200 got in, and like 62 of us ended up graduating. So they really whittle it down. It's not for everyone, that's for sure.
Then 200 get in, and yeah, 50, 60 funds come out. Yeah, that's quite the funnel.
Hmm. Yeah.
That's amazing. Who else kind of shaped your thinking around venture capital angel investing over the years?
Brad Feld would be one that comes to
Mm,
mind. I've taken his venture deals course twice now. I don't know if you've ever taken that one, but
I've heard of it. Yeah, I've read his book and his blog a lot. Yeah,
yeah, yeah. So he actually, when he's doing the course, he's right there. You're on the Slack channel with him. You can send him questions and ask him things. It's super cool. And then, like, he's one of the OGs of venture,
yeah.
just from legal diligence and talking about economic and control provisions and how to structure venture deals. Jason Calacanis is another one. I'm an LP in his fund. Going back to, I think his book came out in 2017. So I think like a
Oh,
lot of
you've been in
people.
launch 1, 2, and 3, or
No, I started the syndicate back when he was getting started, but I've been
yeah.
in fund three since fund three.
Oh,
So
nice.
yeah,
Cool.
fund one and two I
Yeah.
didn't get
Shout out
into,
to
unfortunately.
Jason. Someday I'll be on his podcast, hopefully, or he'll be on mine. But yeah, he's a big mentor for me too. Like I've met him a couple times in passing at various events, but never really interacted with him that much. And but yeah, it was really his book Angel that kind of there's this other way of doing startup investing.
Totally.
Because I was exposed to VCIC and venture capital kind of in the stodgy kind of way at Berkeley in my MBA, and it kind of sort of turned me off. It felt more like Wall Street, which I kind of washed out of 20 years ago. I was like, I don't want to do this like you know button down kind of finance thing again. It's just not
Hmm.
my personality. And then
Yeah,
angel investing kind of opened my eyes to like, oh, you can wear a T-shirt and you know hang out with founders and help them.
pretty much. Yeah, and like how to work with founders and how to treat founders, because
Yeah,
I know, like, me being a former founder, like it's tempting to get in there and you meet a founder and you're a brand new angel investor and you want to tell them all the things that they should be doing differently or what's wrong with their business. And I think the big takeaway for me from Jason was just to sit back, let them tell you what their vision is, because they obviously have some unique insight that you don't. So trying not to overwhelm the founder and tell them how they should run their business, that was a big takeaway.
that's amazing. Well, kind of where do you see the future of Allied and the future of VC in Canada, and yeah, what are you hopeful for in the next 5 to 10 years?
Yeah, I think Canada will always be a springboard to the US. Like everyone that comes here, whether, we have the startup visa program, so a lot of people come here and start companies and with the goal of ultimately getting to the US, or a lot of Canadian founders, it's just with a population 10 times larger, you're naturally going to gravitate towards the US. So thankfully, Canada, we've done a lot of stuff recently with regards to tax credits and stuff. And like I said, the startup visa program. So it's becoming easier. Now, we used to have something called like similar to the QSBS. Sadly, our province got rid of that a number of years ago. So we've
Hmm.
been lobbying to try and get it back. Again, like there's no shortage of talent or innovation here. But ultimately, if a founder, going back to my point from earlier, if a founder wants to build a venture backable business where most of their customers are based in the US, most of their funding comes from the US, then they're most likely gonna transition and move to the US eventually. So I'm hopeful for Canada and I'm excited. It's going to be a longer transition, I think, as we get more technology exits that kind of mince the next
Right.
generation of angel investors who can then seed the next generation of tech companies. And thankfully, we're getting some big ones now with Shopify, and Neo Financial is another one. We got Slack. So it's just going to take time, right? Like it's a decade long transition process. But yeah, no, I'm very hopeful for Canada and it's an exciting place to be.
Well, why don't we wrap up with a rapid fire?
Yeah, sounds great.
What was your biggest challenge in scaling Allied?
That would be the durability of capital. So I think, like, I love syndicates, but they're inherently flawed in the sense that you need to reach a minimum viable consensus in order to fill your allocation and make it work. And
Mm,
we
mm.
know that the best deals are typically not the consensus deals. So it's kind of a catch
Yeah.
22 there. I'm sure you've
This
ran into that.
this so many times. So many times. Somebody told me, a fellow syndicate lead, he goes, once you figure out you're actually not investing in companies on AngelList, you're just equalizing access, your life will be way easier. And what he
Mhm.
meant by that is you're not actually doing all the things we talked about, how we pick founders, how it's a case by case, and how we really dive into the market opportunity, the timing, the team. Most investors on AngelList just are just following shiny objects. Meaning they're kind of looking, oh yeah, Sequoia's in the round or A16Z's in the round. They're smart, right? I'll just invest. I get to co-invest with them.
Mhm.
Yay. But what they don't tell you is they don't hit unicorns at any higher rate than anybody else.
No.
So what is it? And historically you might say like YC was 5 or 6%. We'll see. 10, 15 years ago, they still churn out lots of amazing companies, and we have a big focus there. We have 60 portfolio companies there out of 160. So, we're big fan of that program, but nobody tells you that all these big shops, they hit unicorns at just like the rest of the market, 2.5%.
Yeah, that's it.
So they're no better than you. They're no better than a monkey throwing darts at a TechCrunch.
especially at the early stage, right? Like Sequoia might be coming in at Series A or B, where there's a lot more clarity around the market and the traction. But look at like Airbnb and Uber. I think were great examples. I think they pitched like 100 investors, and 97 of them said no, and just a handful said yes. And that handful, none of them were tier one firms. They were all a
And you
hodgepodge
miss
group
out on a
of,
10,000, 20,000, 30,000 X opportunity
yeah,
because you want to feel like you're smart and you can add value.
exactly. If
It's
everyone's
a
chasing
crazy,
the
it's
same
a little
deal,
dirty secret that nobody talks about. I mean, I think I've talked about it a little bit this podcast, my blog posts, and a little bit, but if you just look at the stats of the industry, it returns. It's the best asset class, 25, 30%, average. But the problem is this IRR, annual returns, depending on the vintage, depending on the asset class, all that stuff. At seed stage generally. But the problem is the standard deviation is the same. It's also 25%. Some funds return nothing, or just like basically their capital back, and some funds kill it, and have 100x. Like, how do you, how do you kind of think about all that?
but just even
I get fired
myself,
up about it, obviously,
yeah,
but
no, I'm the same way. And like, still me, like I'm a personal, like my personal portfolio, the angel checks and the stuff that I do, I still invest a lot through other people, and I try and add one new fund manager a year to my portfolio. I'm now an LP in 6 funds. And for me, it's just about like, who's sort of an emerging manager, a small fund size where they're not competing with the larger Series A people, and they have unique access to some type of network or some type of geography where I think some really interesting companies could emerge. And that's basically it, because at the end of the day, like, we're all kind of throwing darts to some degree and no one has a crystal ball. And then our job is to try and figure out who those companies are, get them to that Series A, where then ultimately Sequoia and the big people do come in and take over from there. But yeah, like emerging managers with the unique markets and the unique networks and access to deals that I think the big guys are kind of overlooking because they're not really on their radar yet.
right. And it's a truism in venture capital. If you look at the data, the longer you're a GP, the worse you get at this.
Yep.
There's an inverted U that happens, or maybe like an S curve. But basically, the new managers, as you know, outperform. Right?
Yep.
They're usually the majority of the top decile, definitely the top quartile. But over time, as you get a couple decades into this, you kind of get set in your ways, right?
Mm-hmm.
You kind of like, I've seen this before, it didn't work, or I don't understand like how Web3 works, I'm not going to invest, or like, so you kind of get kind of set in like your lane
Mm-hmm.
a little bit.
Yeah.
And it's why I like being a high volume investor, because people will say, oh, that's spray and pray, you don't know what you're doing. But my reaction to that is like, no, there's 10,000 companies that get pre-series A funding every year, and 200 of them are going to turn into unicorns.
Mm-hmm.
So, like, logically, you would want to invest in 200 a year. You'd want to say, hey, I'm going to try to find the 200 a year. They're going to be billion-dollar companies.
Mm-hmm.
And so that's kind of been our strategy as a seed stage investor. We're obviously, not in a position to invest in 600 companies a fund or 200 companies a year yet.
Mm-hmm.
But I think also, if you follow it logically to your story in Airbnb, if 97 investors out of 100 said no, they probably said no because they're like, well, yeah, I'm writing $1 million, $5 million checks. This is going to be one of the 30 checks I write in my fund. And I'm just, I'm not confident on this. But if you're the kind of fund, and I've talked to lots of funds like this out there that are much higher volume, and, like Soma Capitals of the world, they're the General Catalysts. They're just cranking out 10, 12x funds because they invest in hundreds and hundreds of startups because they don't have to worry about returning the fund with their. So it's a different strategy. How do you think about all that?
No, for sure. And similar to yourself, like you have the platform where you can participate in follow-on rounds, whether that's through the syndicate or if you keep reserves in your funds, but you have that optionality, right? So like for us, like I would love to have a pre-seed fund where we write a high volume of small early stage checks and then double down on the breakouts as they progress through seed and Series A through the syndicate. And I think that's where you really start increasing your returns at the firm level, because you have these multiple vehicles, you're getting larger ownership percentages in your top performing companies. So that's the way that I look at it. And that's my longer term vision for Allied, is to have that fund syndicate co-invest model. But if you just have a one-off fund one with no ability to take pro rata or double down on your top performing companies, yeah, it becomes very difficult. Like the venture math is very, very difficult.
Well, I'd love to dive into that exact thing. I want to talk about that for a sec, because there is these two camps for follow-ons, and Jason's talked about this pretty transparently on his podcast. And I tend to come on the side of Jason, I think, which is when you have to choose between doubling down or making more bets, there's a diminishing return to making more bets. But we just talked about, like, where's that number? It's probably 200, right? Like if 200 companies are to become per year startups are eventually going to become a billion dollar company, just logically, you want to say, hey, I'm going to invest in the 200 every year I think that are going to do that, right? Or maybe it's 100 for on Thesis, because maybe half of them are off Thesis. They're consumer biotech hardware and you don't invest in that or whatever.
Yeah.
I don't.
No, me neither.
And so you'd want to kind of get to that place where you're like, I think I'm going to do the 100. And once you can get there, and then you have a big enough check size, call it in pre-seed and seed to get major investor rights and stuff like that, probably a 250K check size, something like that. So really, you want to get to the place where you can write $25 to $50 million worth of first checks per year. So that's that's a $200 million fund of just first checks over 3 years, if you want to do a 3-year deployment period. And then, only then, would I actually want to make follow-ons. What do you think about my logic of what I just said? I've been thinking a lot about this.
Yeah, I mean, I do agree. Like, I think you definitely want to maintain your reserves. You want to put in larger checks down the road when the breakouts start happening. But like from a logistics standpoint, I can't even imagine how I would make so many investments or be able to vet so many companies. Obviously, you've got a much larger team and a much larger platform. But yeah, no, I think the math pans out, and ultimately,
I feel like I have 100 spinning plates in the air at all times over here.
Well, yeah,
in my little home office here in California. I'm starting to build in some AI workflows into my processes, which is helping especially for deal screening, portfolio updates. What do they need? Summarize it. How are they doing? What's their MRR? Where are they struggling? Who can help? Like all these like little operational workflows we're starting to automate. We're not there yet. We're 15% of the way, but we're at least on the way. But I'm confident in the next 4 or 5 years that we're going to be able to really amplify GP time with AI.
Going back to your point about Jason, like I think recently he said that he's got this even smaller fund now where he's writing 25K checks into companies that aren't even formed. It's just two people with an idea on a napkin. So, and I think he's trying to do
and getting
like
good equity.
Yeah, he's getting a good chunk. So
and
yeah,
that's a good strategy. I think what he's done, to your point, has gone earlier and earlier with launch and the accelerator and these like angel university or founder university things.
Yeah. And that way you're not competing with the larger funds, right? You basically have carte blanche, your pick of the litter. You can do whatever you want. And then
here's my problem with this. Here's my problem with this strategy.
Okay.
I think there's a bias that creeps in. There's a sunk cost fallacy, right, that humans have. And so he's getting in super early, with these 25K checks with a big chunk of equity. And so now as you get into the pre-seed round, the post-accelerator round, the seed round, there's a bias that creeps in where I'm trying to prop up this company because I have a 5 to 10 or 15% equity stake and I don't want it marked down and I want to see it exit because I have this big equity chunk. And so like in a way, you're almost disadvantaged to be a multi-stage of VC because you let perverse incentives creep in and biases creep in. Yeah. It's better to stay, I think, and maybe my thesis will change over time. I think it's actually better to stay in your lane, right? I am a pre-seed, maybe a pre-seed and seed investor. But I think by launch going so early, yeah, they're going to get equity and stuff. But I see some stuff come out of them, their deal flow and their accelerator. They're writing checks, 500K checks into stuff. I'm like, I wouldn't even dare write a 500K check into this. Like, what are you doing?
Yeah.
No offense, Jackie and team over there, if they're listening. But yeah, what do you think about the bias that can creep in?
I mean, maybe that goes back to our consensus versus non-consensus point from earlier. But yeah, no, totally. I think with the bias creeping in, particularly the sunk cost fallacy, I think it really then just comes down to the temperament of the individual investor. Do they recognize that bias? Do they know that, okay, yes, I've got 5% in this company, but if the company's not working out well or things aren't going as planned, then I have to be able to walk away from that. And yeah, it's a very, very difficult thing. Like you said, I think it really comes down to the individual, the GP.
It's good money after bad. And I see it in founders that I invested pre-seed where they're not doing well. And I see the lead like putting a little pittance in there because I feel like they have to. And that's not the right follow-on strategy. I think Jason talks about this, like the right follow-on strategy. Hey, you're in the top 5% of the 100 checks I wrote last year.
Yeah.
You're the top like 4 or 5 companies and I'm going to follow on. I think that's the right strategy. But I think so much of what happens is like, I got in so early with such a big equity stake that I really want to prop this up.
At least for him, because he's got so many companies, he can benchmark that company against all the rest of his portfolio and all the data he has. So he can actually say, yeah, this is top 5%, let's go big.
Bingo.
Versus, oh, this is like bottom quartile, second quartile, maybe not so much.
We're doing 100 per year now across all our vehicles, not follow-ons. These are first checks for us, for our firm. And that is the benefit to being a high volume investor. You just see so much. You see so many terms, so many investors, so many teams and the updates and how they execute. And so you just develop that pattern recognition.
Hmm.
And it's just a different way of doing it. I've had people on that do the 20 or 30-year fund, and they love it. They love sitting on
Hmm.
the board and diving really deep. And I think it's so risky to do that. You're just risking blowing up so easily.
It is really tough, 100%. I don't know, like you'd have some sleepless nights for sure if you've got this massive portfolio with just 20 investments. Some people I know, even through the VC Lab program, I met some GPs that their target was 10 to 12 to 15 investments, like super, super concentrated. And I'm just thinking to myself, like, even from my own personal angel portfolio, which is now over 100 companies, like I didn't really start to feel comfortable that I'd have some type of winner or breakout until I got to like the 40 to 50 range.
Agreed.
Because if you're
Yeah.
investing at the early stage like that, like you just don't know, right?
Yeah. There's a feedback loop, but it takes years. And some people say it takes like 10 years. But as an angel or early stage investor, you can start to see it after, a couple of years, 2 or 3 years of investing. You're like, oof, I shouldn't have done that. I learned my lesson there. And you make a bunch of mistakes. And yeah, after you get to about 40 or 50, I think Jason says in his book about 100. I remember hearing this in real estate. I grew up in a fixer flipper real estate family, and I'd listen to all the real estate, books and podcasts and stuff. And they say, oh, you got to go look at 100 houses in the neighborhood before you buy one. And it's kind of the same as an early stage investor angel. You have to look at 100 startups before you invest in one.
Yeah.
And that's kind of the ratio. I'd say even now I'm probably 200 to 1 or 300 to 1 for every investment I make. I've looked at 2 or 300.
And that's what I tell new angels. Like, if you go out and you start trying to write direct checks into companies and meeting with founders, like you're going to see 10 companies and then you're going to want to invest in 7 of them. But fast forward a year, you see 100 companies, you're still probably going to only want to invest in 7 of them because you've seen so much more. You've got so many more reps under your belt. And I tell new angels, like, don't try to start by writing direct checks and meeting with founders. Like, join a syndicate, join a fund as an LP, and just start seeing more and more deal flow. You don't even necessarily have to write checks, but just learning what experienced investors are looking for, why they like deals, what the types of risks that they're highlighting, and just like weeding out a lot of the basic rookie mistakes that you can make in your early days.
Yeah, I love that.
Mm-hmm.
What's the most impactful book you've ever read?
Essentialism by Greg McKeown. I think if you've ever read it, it's just
Oh,
like how to filter out the noise and really focus on what's most impactful, both like in your personal life and your professional life. So highly recommend. That's my most recommended book to everybody.
Essentialism. I'll check it out. Top skill every founder should have.
Well, the ability to public speak and sell themselves. I think like as a founder, you're always selling your vision to customers. You're selling your company to investors. You're selling it to employees. So you can get up in front of a group of people and feel confident and public speak and sell yourself, that goes a long way.
I love that. And it's why when I meet with a founder, I actually have them pitch me the deck because I want to see how they come across. Do I see them ringing the NASDAQ bell someday? Do I
Yeah.
see them being on CNBC doing an interview? Pitch me. Let's see.
And I think about it like if you walk into a room of 100 people and we already know 95% of people, they're not comfortable with public speaking or they say that they're not a good public speaker. So if you're a decent public speaker, you now have an edge over 95% of people in that room, right? So it's a massive edge to have, I think, just in life and in business.
Yeah. And we're one-on-one typically, right? You're meeting with a founder one-on-one, so you should be comfortable. It's fine if you don't want to get in front of 1,000 people, but one-on-one, when you're pitching like investors one-on-one or being interviewed one-on-one, you should just be able to nail it because that's going to be mostly how things are won. And then you can learn the kind of the Toastmasters public speaking later if you need to. What's one tech trend you think is overhyped?
I think the rush to build application layer AI companies, like if we look at history, like internet, for example, search, mobile, like we typically see when a new technology platform comes, everyone's rushing to capture market share in the early days, but the underlying infrastructure is still evolving, right? We don't know what it's going to look like long term. And then typically there's some type of bubble that pops, things reset, and then it's the longer term, durable, sustainable companies that emerge out of the dust and the rubble from that.
I love that. That's such a good insight. And I think Chamath Palihapitiya said this on the All In Pod, or maybe it was at the All In Summit. He said that every time there's a platform shift, you kind of keep moving up the stack. That's where the opportunity. So like right now, all the profits are going to NVIDIA. They're getting it just hand over fist, printing cash right now. But now the networking layer is kind of the next one. And it kind of moves up from there to the platform layer, the API layer, stuff like that. And it's kind of like a gold rush analogy, right? AI, there's a platform shift. It's a gold rush. And the picks and shovels, the Levi's, Strasses of the world are where the money's being made right now.
Yeah, but you had to be investing back in 2016, right? Like OpenAI and stuff. So like that ship has
like
long
you and
sailed.
we started deploying our own capital, it sounds like 4 or 5 years ago. So we were already too late. And so we almost have to be up little higher in the stack.
Totally, yeah. And now, like, I don't know about you, but I probably see a different AI for lawyers startup every month or every couple
Oh
weeks.
yeah,
And like nothing
easily.
against those founders or the lawyer community, but honestly, I just don't know how to differentiate between all these companies that are going after the same market. And then if the underlying infrastructure from OpenAI or whoever you're using on the back end shifts, and they decide they want to open that up, like it's just the bottom could fall out overnight. It's just too hard to predict like anything more than 18 months out at this point
Yeah,
because it's evolving so fast.
yeah. Well said. Well said. What's your preferred networking platform? How do you prefer to network?
I like LinkedIn. I just find there's less bots and noise.
Yeah, yeah. I've never been able to penetrate Twitter X.
It's fun to hang out on, but
But anyway, who's the most inspiring entrepreneur you've ever met?
so one of our portfolio founders, her name is Christina, and she's the co-founder of Edify out of Austin, Texas. But yeah, just quick background on her. She emigrated from the Philippines, put herself through Yale, worked her way up in the luxury restaurant and hospitality industry in New York City, and then she opened and managed a hotel chain before launching her own tech company now. But just someone who's come from overseas with no network and put themselves through school, worked their way up in the luxury hospitality industry, and now is launching a hospitality startup. I think that's just super impressive, the number of obstacles she's overcome over the years.
That's amazing. And if last question, if you weren't in VC angel investing, what would you be doing?
Probably co-founding or a company or working at an early stage startup. Like to my point from earlier, I just love those early days of building a product from scratch and then getting people
Mm,
to pay their hard-earned money. So I also, I guess the one thing that I miss as a solo investor now is just I miss the team aspect. Like I come from the sports world, so I love building as a team, winning as a team, succeeding as a team, and yeah, so just being in the early stage trenches at a company is just so fun in my opinion.
well, really enjoyed the conversation. Thanks for hanging on a little bit late. Where can folks find you online if they want to get in touch with you and Allied?
Yeah, our website is allied.vc. You can also find me on LinkedIn or Twitter. My handle is at Matt Wilson, YYC.
Well, thanks so much for coming on. Really enjoyed it.
Thanks, Brian. Appreciate it.